Welcome, everyone. Thank you so much for coming to our working lunch here at the IMFS. My name is Alexander Meyer-Gode. For those of you who don't know me, I'm one of the three core professors at our institute here, under the leadership of our managing director, Volker Wieland, who's here as well. And so the idea of these working lunches is, right, we've got some sandwiches, something to feed your stomachs while we're feeding your minds here in a couple minutes with the contributions from Michael Bauer. And it's my great pleasure to have invited him and to introduce him here. Michael Bauer follows right in, Volker Wieland was at the board for many years, is German and is now here at the Goethe University. We have Michael Bauer, who's come from Hamburg or close by Hamburg to St. Gallen, then to University of California, San Diego. That's in La Jolla, right? Right. Yeah. So from one coast to a warmer coast, San Francisco Fed, then back to Hamburg, and then back to the San Francisco Fed. So we've got lots of transatlantic interest, cooperations, understanding, and that's where I fit in fantastically here then as the American who's come to Germany working the same topics. So we're today, of all days, April 1st, April Fool's Day, April. The whole idea here is to talk about and think about surprises, and not of the joke kind that give your mother a heart attack, but rather monetary surprises. And we have no better person to talk to us about that than Michael Bauer, who's published in journals like the American Economic Review, Quarterly Journal of Economics, Review of Economics and Statistics. Also very influential is at the 2024 Jackson Hole Symposium. Right, the idea of monetary surprises here, measuring what they are. I was fortunate enough a couple weeks ago to be in San Antonio, where a co-author was presenting their work, or an overview of their work about things such as the information effect of monetary surprises, right? So the central bank, when it raises interest rates, does this mean that it's going to be bringing inflation down? Or is the central bank telling us that they know something that we don't know, and the economy perhaps is suffering from more inflation than we had thought? And disentangling and understanding these effects is at the core of this sort of understanding our event studies, information components, and a lot more deeper and with new financial market reactions is going to be the talk today. So we have 1 hour, and we'll first have the presentation by Michael Bauer, and we'll hopefully have time for a Q&A session then afterwards. So the floor is yours. Thank you very much for coming.
Thank you. So I should go for an hour with the presentation, and then there'll be a Q&A?
No, the whole thing. We've got an hour for the whole thing.
Okay, until 1:30, and then we're done.
Yeah.
Okay, great. Okay. Yeah, thank you so much for inviting me. It's an honor to be here. It's this work with some Fed colleagues, and Miguel Acosta at Wisconsin, Silvia Miranda Agropino. Is currently at the New York Fed, but she's coming back to Europe. She's going to join Oxford in the fall. And the usual disclaimer applies. Okay, so Alexander already mentioned these surprises, right? So monetary policy surprises, for those of you that aren't familiar with them, are basically changes in interest rates immediately around the announcement of a central bank about monetary policy. And they have been widely used in macro and finance for in empirical work because they're really helpful to identify causal effects. Because because they're predetermined, right? So the basic idea is that if you observe some kind of surprise in interest rates or high frequency changes in interest rates around an announcement, and then you also see the stock market moving in a certain direction, you know that this is a causality going from this interest rate change to the stock market, and not the other way around, because this monetary policy announcement was determined ahead of time, right, over the meeting of the Monetary Policy Committee over the days before this announcement. And so ruling out this kind of reverse causality is one of the appeals of these event studies that have been used to identify financial market effects. And you can use a similar argument to identify effects on, beliefs and forecasts. And also you can use these high frequency changes in interest rates as instruments in VARs and local projections. And so then you can actually trace out the effects on the macroeconomy too. So empirical macroeconomists have been very fond of these things. And I've done a fair bit of research myself on them. But there's some issues that we'd like to address in this paper. And the first set of issues are data issues, basically. So for the US, you'd be shocked to hear that there's not actually a database of high-frequency monetary policy surprises that you can go to. There is like this infamous Excel sheet that people have been sending each other over the years, but that's been discontinued. And there's authors that, including myself and Eric Swanson, that make available updated data for their papers that you can download from their website. But this is kind of unsatisfactory because there's different methodologies, some of them a little bit intransparent. It's also quite narrow in scope. And who knows, if one of these co-authors, I don't know, retires, then there won't be any more data series there to download, right? So the Bank of England, the ECB, and the Riksbank, they have nice public databases regularly maintained, and the Fed does not have that. And one of the goals of this project is to create that database. Yeah. And so this is a collaborative effort with other people in the system, using the best practices about the construction of these surprises. So, I mean, this is kind of just like, just the brunt work of doing this. This is not particularly exciting, maybe scientifically as a project, but that's hopefully going to be helpful for other researchers that want to use this. We also want to extend the data that's available, though. We want to include other communication events that are not part of these data sets that are available, including the post-meeting press conference. And you'll see in my empirical results that that's been actually become really important to think about the financial market impact of the Fed's monetary policy. Also, the minutes of the FOMC meetings have been released 3 weeks after the meeting since 2005. And so those are events that we should not ignore. We should look beyond just the policy announcement itself. Right, and then so beyond these data issues that are relatively straightforward to address, there are also open questions and material research issues here that we need to that we need to think about and that we can contribute to in this paper. One is that if you look at market-based inflation expectations from TIPS break-evens or inflation swaps or things like that, you actually find no response to monetary policy announcements. So that's kind of a shocker because in the monetary VAR literature and according to our intuition, right, inflation goes down after monetary policy tightens and vice versa, right? And so the absence of that response in market-based inflation expectations that these authors, these studies have found, that's pretty puzzling. And so that's something we want to address in this paper. Another area, Alex mentioned this, is the whole Fed information effects literature. I mean, there are some pieces of evidence there that are a little bit puzzling still in the area of risk assets and how they respond to monetary policy. So, for example, there's some papers that show that the stock market sometimes goes in the wrong direction, quote unquote, right? So when the Fed surprises markets with higher interest rates, usually you'd expect the stock market to go down, right? Higher risk-free discount rates plus bad news for future dividends, so it should be unambiguous that it goes down. But sometimes it goes up and vice versa. And so these kind of frequent wrong sign surprises are a little bit puzzling. And then also, couple of papers have found that dividend strips, these are, I can talk more about what they exactly are, but basically they pay off based on future dividends. They not only sometimes go the wrong way, but on average go the wrong way, right? And this is a forthcoming JFE paper here by these guys that shows that dividend strips respond positively to monetary policy. So there's some puzzles here that we also want to address. Also, we want to think a little bit about the recent episodes because there hasn't been a paper that has done that. Big hawkish surprises really since liftoff in March 2022. What did those announcements do to financial markets? And then lastly, there's a big debate about lags of monetary transmission, right? When the Fed tightens, how long does it take for all these effects to materialize? So you can estimate all kinds of VARs and local projections and try to tease that out, but that's all going to be pretty backward looking using decades of data. So with financial market data, we can look at this in a forward-looking manner. We can look at the expected lags. If we have a whole term structure of interest rates or term structure of dividend expectations or inflation expectations, then we can really look at what does the market expect? How long is it going to take until monetary policy has peak impact, right? So we contribute to these questions. So we'll establish this new database. Okay, we'll address these puzzles about the absence of the inflation response and about this puzzle about the dividend derivatives. And we have new evidence on the press conference, these other FOMC communication events, and we have something on expected lags. Okay, so just in case I don't get to everything, which I'm sure I won't, here's like a high-level summary of the findings of the paper. So first, we do find, by extending this sample and these communication events, we do find a significant negative response of market-based inflation expectations to monetary policy, and so that kind of reconciles this VAR evidence with the market-based evidence, okay? And we show why we find something different than earlier studies, and so that's, I don't know, satisfying maybe, or disappointing that there's no more puzzle there, I don't know, but that's kind of what you would expect, right? And so it is actually there. There's really strong effect of the press conference by the Fed chair. So like this whole literature, really including our own past work, has focused on these 30-minute windows around the FOMC announcement. But this is not enough, right? Since 2019, every single FOMC announcement has been followed by a press conference by the chair. And so we need to include that information when we study financial market response and also when we use these financial reactions as instruments for VAR. So really the recommendation of the paper is that the new baseline monetary policy surprise should include the chair's press conference. And this is particularly interesting in the post-pandemic episode where these large hawkish surprises around the FOMC announcement. The chair kind of walked back some of those. It's not exactly clear why, but if you then want to look at what did this policy decision really do to financial markets, you need to include both the response around the announcement and what the chair later did in the press conference to financial markets. And so with the risk assets, we do address these kind of wrong signed responses, and it's they're really not that frequent at all. It really is It is really rare. It is rare that the stock market goes in the wrong direction, in particular around press conferences, in particular if you look at policy surprises that are large, which are the relevant ones. And then we have novel evidence from dividend futures and swaps that we think are a lot more reliable than these imputed dividend strips, and they go out several years in horizons, and so you can, so we find they respond negatively, as you would expect from monetary transmission, lower dividend expectations with tighter policy. And you can get some novel evidence there also about the expected lags, because now we can see at what horizon is monetary policy expected to have peak impact on future dividends, right? And so the lags are long. They're really quite long, both in the inflation derivatives and in the dividend derivatives in these results, they're like 3 to 4 years. So so that's really quite a bit longer than we find in the VAR literature, and maybe that's a new puzzle. Okay, so all right, this database, I'll go over this relatively quickly. The FOMC statements, everyone is familiar with them. Since 1994, the Fed has released a statement after basically every meeting. And we'll use a 30-minute window around this, right? And so, so we look at the response of like money market futures and all these other assets, like from 20 minutes after the announcement relative to 10 minutes before the announcement. And that's what people have done for years. Right? And then there's a press conference, and there, we'll have a window that covers the press conference. And then we also have like a combined window that has both of these events in one. We call that the monetary event window. And that's really going to be our recommendation that people use that to account for these important pieces of FOMC communication. The minutes, as I mentioned, they've been released soon after the meeting for a while, and so we have a window around those. In this project, we don't include speeches, like chair speeches, some other work, including my own work with Eric Swanson, that have looked at that. If you want to talk about that, we can take that offline, or happy to answer questions about that. Okay, here's some pictures that just say basically, visually what I just said. In our monetary event window, that covers the announcement and the press conference. So everything's in this window. Right? And in the ECB, it all looks a little different, but people also have spoken of like a monetary event window that has the press release and the press conference. And so we're trying to, basically we're moving the analysis of FOMC policy in the direction that, people have already been doing it for the ECB. All right, so this is our sample. The FOMC announcements going back to 94. The press conferences started in 2011. The minutes have been released in a timely fashion since 2005. Okay. And the database includes, risk-free rates, like money market futures. That's really the part that people have focused on. You kind of want to measure what is the expectation for the policy rate over roughly the next year. So you use these federal funds futures for a few months, and then Eurodollar futures, or now SOFR futures, for a few more quarters, so that you cover a horizon of roughly a year. And so then you look at the shift in these rates around the announcements to understand how the expected policy path has changed. We'll include some other assets in this database, but they're not going to be part of the analysis I show. All right, so this is what people usually do, like some things that are based on Fed funds futures for the first couple of FOMC meetings, and then for the 2, 3, 4 quarters out, we use these Eurodollar futures, or now SOFR futures. Okay, so what we'll do here is really simple. People have calculated these like target and path surprises that capture different dimensions of monetary policy, but we'll just do the first principal component, of these rate changes. So basically, it's a univariate summary of the shift in the expected policy path around this event. Okay. All right, and this includes forward guidance when the chair says something about what might happen a few meetings down the road, and it includes a surprise about the target. Let's say the Fed raises by 75 basis points, and people were thinking that it might only raise by 50 basis points. So both of these types of surprises are in this measure. Okay, and so. Not surprisingly, it looks very different if you look at an FOMC announcement and if you look at a press conference, right? These are the loadings of this principal component on the different rates. It's kind of a level factor if you look at FOMC announcements or the combined monetary event, because there's information both about the target here at the short end and about the path here for several quarters out. But at the press conference, there's no information about the target, right? That was already conveyed 30 minutes earlier. And so the press conference is all about forward guidance. And so the loadings, upward sloping, of course. Okay, so this is all kind of as expected, but just so you see a little bit what's going on under the hood. You know, these are our surprises since 2014. I'll just say, you know, here the black line are these are the statement surprises. The dashed vertical line is liftoff in March 2022. And it's a little hard to see, but really this was the biggest surprise of all of them here. And these hawkish surprises, right? So this means interest rates go up in response to this announcement. So that's a hawkish surprise. These were the largest surprises, certainly over this period and also going back quite a bit earlier. These are very big surprises. I mean, it only looks, you know, like 5 basis points doesn't seem like a whole lot, but compared to the standard deviation of these things, these are big surprises, right? So, however, the chair kind of walked back some of that. You see here the big negative press conference surprises that sometimes go in the opposite direction. So, you know, some people have written papers about this particular episode, or, you know, this has really caught the attention of people that, and for us, what matters is that, you know, it shows that it's not enough to just look at the statement. It really is important to also look at the press conference, either separately or in combination. Okay, right, so let me, yeah, question.
Question on that. If you look until 2019, there's not much difference between the monetary event and the statement surprise. I mean,
right.
They're highly correlated.
Yes.
So the big difference is afterwards, I suppose.
That's true. It's not, I mean, this is a subset of our sample, a sub-period. Exactly, right? So over this period, it might be enough to just look at the statement surprise. The press conference has kind of reinforced the point and doesn't have independent information, but it's not always the case. Yeah, exactly. So in the most recent episode, that's not the case. So it's like episodical. Like sometimes it's enough. Sometimes you really want to look at both dimensions of it. Exactly. Okay. So yeah. Let me just say about this slide, which you know, we call them surprises. They're these 30-minute changes because that's kind of how we think about them. But there is actually some evidence showing that they're actually predictable to some extent, and that matters in some contexts. In particular, when you go to VARs, and you need to worry about these omitted variables. But it doesn't matter for this paper because in these event studies of financial markets, there's not an omitted variable. Okay. If you're interested in this issue, I would direct you to my NBR macro annual paper with Eric Swanson, where we drill deeper into this. Okay. Okay. So let's look a little bit at the treasury market, and then we'll look at risk assets. Okay. So in the treasury market, we'll run these kinds of we'll always run exactly this kind of regression. This is the only equation in this presentation. I hate to admit. So this is the daily change in an interest rate, or you know, a forward rate or yield on the day of the monetary policy event. And this is the surprise, which could be the one either around the announcement or around the press conference. And this is the coefficient of interest here, the gamma. And so we'll look at, you know, nominal rates, tips, yields, and forward rates. So treasury, inflation-protected securities are basically real interest rates. Yeah? And the difference between the two, which are either called break-even inflation rates or inflation compensation, and they essentially measure market-based inflation expectations. Yeah? So the questions we're interested in is there excess sensitivity in long-term rates? Is there a response in break-even inflation rates that's consistent with monetary transmission, so negative response? And does it, you know, do press conferences have an interesting impact on the treasury market? So as a motivation, this is the table from Nakamura Steinson. Yes, question. Yeah.
I understand that press conferences in general are important. That will be also the topic of the press conference will be. So if they are announcing QE or QT versus a change in the interest rate, of course the impact on the treasury can be different.
Right, exactly, right. So, I mean, what we do here is we're just going to look at the this variable here is only going to capture the shift in the expected policy path around in response to the press conference. So basically the forward guidance components as captured by financial markets, right? So so we're not going to look at what's in the press conference, like text analysis. We're not going to look at, Eric Swanson has this other work where he kind of goes out further in the yield curve to look at the QE surprise that really only affects long rates. That's only going to be in here indirectly. So those are dimensions that we don't look at in this paper. Yeah, but very important, very important. Okay. Yeah, so Nakamura Science in their widely cited QJE paper, they look at the last column here is the basically break-even inflation rates. How do they respond to monetary policy surprises? And they basically don't respond at all. Right? These are positive, insignificant coefficients. This is all zero, right? There's a very little bit of like very, very long run instantaneous forward rates. But we would expect monetary policy to have big impacts at the year of like a few years out, right? 3-5 years should see something. They didn't find anything, okay? So that's part of the motivation here. Okay, so this responds to FOMC announcements, the surprises around announcements. So let me just, there's nominal rate response, real rate response. You can think a little bit about excess sensitivity of long rates, but let me just skip to the response of break-even inflation rates. Like in our sample, they respond negatively. Here, the 5-year yield, 10-year yield, and the 5 to 10-year forward rate. The 2-year yield responds negatively, but it's not significant. So that's kind of more what you would expect. Yeah. So that's a big difference from the results of Nakamura and Steinson. We look into why they find different results. It's really the sample. And I'll show you that in a second. But it's still, it's really low R squared, and these are not very big effects, but they're there. I'll show you in a second that if you include the information from press conferences, then you find materially bigger effects and a stronger correlation there. So it's also important to not only extend the sample to include the last 10 years that had a lot of action on this front, but also to go beyond just the FOMC announcements. This is a term structure response. So that's just a different way to show the same result here in the right panel. It's the response of break-even inflation forward rate. So each bar is a response of a specific forward rate. And here you can see kind of the horizon pattern. And you see that the peak impact is around 3, 4, 5 years. Yeah. So 4, 5, 6 years really. Right? So so it takes a while. Or investors think it will take a while. We can talk about risk premia, but that's a longer conversation. Okay, risk premia would, if anything, make this accounting for risk premia would probably make this more negative. In this paper, we stay away from using risk premia, which are always very imprecisely measured. In particular, daily changes. There's no real way, no simple way to get reliable inference about risk premia. So this includes both expectations and risk premia. Yes. I'm sorry?
So did you look also to the time premium?
No, that's what I meant just now, that we're not looking at inflation risk premia, real term premium, nominal term premium here. I mean, what you need to do is you need an estimate of the term premium, but they are so imprecise and so uncertain across models, and there's so much estimation uncertainty that you basically can't say anything. So when people have tried this, there's, like I will say, like there is an unfortunate, tendency in the literature to download term premium from the New York Fed's website and treat them as data. But they are not data, right? They are, you download something that's a point estimate, but under the hood there is a confidence interval that's like this, right? And so I would caution against taking the term premium from either the New York Fed's or even the San Francisco Fed's website. We also have one. but we did not use it because to really do this, you need like a full like term structure model, a framework that accounts for this estimation uncertainty, and this is beyond the scope of this paper, certainly.
And in the slope, you're not looking also to the slope, the change in the slope. Because you're looking to the short-term rate and the long-term rate, but you know, a story can be also attached to the difference between the two.
I mean, this gives you some indication of the slope, right? I mean, I want to emphasize this is the break-even term structure, right? But even here, you know, the forward term structure, there is a change in the slope, right? Like the slope, because the short end doesn't change as much as medium and longer term rates, so the slope changes of this term structure in response to this type of announcement. But maybe you're getting at the slope versus level in the announcement surprise, target versus path. Yeah, we have some additional results in that's like appendix material basically. I mean, it's they both target and path surprise have these kinds of effects. So there's not like a really interesting difference between the two.
So it's all driven by inflation expectation. This is your story.
So, okay, so this negative, like our story is that the response of the inflation risk premium would likely be positive, because the inflation risk premium on average is positive, and monetary policy has been shown to be positively related to the level of the magnitude of risk premia. It increases like risk prices and all risk premia, and so it would tend to increase all risk premia, and so accounting for that positive effect, if anything, would make this more negative. That's kind of what we can say by waving our hands vigorously, okay? Yeah. So the difference with Nakamura-Steinson is really due to the sample period, and that's maybe better, easier to see here. Like over the first sample period ending in March 2014, which is basically when they ended their sample, you have essentially no relationship between monetary policy surprises and the 5-year break-even inflation yield. But in the period since then, since April 2014, you do get this significant negative response. So this kind of shift, and it's not just post-pandemic, it's also the Yellen lift-off for 2015, 2016. Anyway, so we can kind of drill down deeper into like what really caused this shift, and we think that's pretty interesting. But let me move on. This is just a summary. Don't have any time for the summary.
One question. So if you say, okay, when it's encouraging, or if you go back to the previous slide.
This one?
This one here. So it's encouraging to see this negative effect. So if you think there's a surprise that policy is higher than you expected, and industry inflation, forecasted inflation is going down, right? That's the result.
Yeah.
But what's the logic that this has? So you have this surprise within a few minutes, right, before and after some announcement, and that makes you change your view, or in this case, presumably the market outcome of trading these bonds. Change the view of what happens in 6 years. But what's the economic logic? I mean, would you really think that our surprise about, we slightly misestimated what the Fed would do, starting from a few minutes before, why would that change my view where inflation will be in 5-6 years? I mean, the only the way this could change my view is if somehow I found out something about the Fed's inflation target. It has changed. But the effect of its policy, why should it have an effect in 6 years?
Right. Okay, so I think, so on the one hand, on the other hand. So on the one hand, I think it's plausible that if you have new information about the future course of monetary policy, material, significant new information about how tight the Fed is going to be, this should change your inflation outlook. According to monetary VAR estimates, let's say the traders just go to this VAR estimates and say, okay, now first I had this path for the policy, now I got news, now I plug in this other path, that should change their inflation forecast for several years out, I think, according to these mainstream estimates. I guess, but I think what you're getting is puzzling that it lasts so long. So I don't.
On the one side, we have central banks who can't even forecast the next 4 quarters very successfully. And then we think what they do has an effect in 5 years here, right? The peak effect.
Yeah, no, I think that the fact that there is a large degree of uncertainty around the forecast doesn't take away from the need to make a forecast and for traders to form a forecast. So it's not particularly surprising, I think, that these are in the end going down. What's surprising is that they last so long.
But if you know that they will have a significant, basically predictable effect on inflation in 5 years, that should allow you to forecast inflation at some point, right? If you think
that's right.
Policy change, you've tried to identify the policy change from a surprise, right?
Yeah.
But given the policy change has an effect, if that's significant, then it's predictable 5 years into the future.
That's right, and it is, right? That's what we know from the monetary VAR literature. That there are, like these VARs just pick up this exact relationship between monetary policy today and inflation 3 years down the road, and they show that there is this effect, right? And local projections. So yeah, the uncertainty is huge. The shocks are there's a lot of unpredictable variation down the road, but there is a correlation between monetary policy now and inflation 3 years down the road, right? And so that was kind of, the puzzle was really that the traders would not react to that, although it was there. Now we have a different puzzle also. I mean, I think I agree with you. It's puzzling that it lasts so long. Like 5 years down the road, we'd maybe think, or like, I mean, here we find like 8, 9, 10 years. This is kind of like the only way this could really make sense is if there is like something about the inflation target or some kind of unanchoring that it would last so long. But yeah, that's so it's not resolving all the puzzles, and reasonable people can disagree of like how puzzling it is that there's some effects several years out. But yeah, I mean, the fact that it is from 5 minutes before to 10 minutes after, that's just an econometric technique to identify a causal effect. I mean, but that's how quickly financial markets can process the news, I think. Yeah.
What's the magnitude here if you go back? So is it like
yeah, so
basis points surprise is half a basis point?
Basically. So the surprise is normalized so that 1 unit moves the 1 year nominal yield by 1 unit, right? And so a surprise that moves the 1 year nominal yield by 10 basis point moves 5 year forward break-even inflation down by 5 basis points. Okay, so let me show you a little bit about the press conference. I guess so this table here has lots of numbers, so I apologize for that. But basically, the first column here, statement, that's what we have already seen. That's the statement surprise and the response of the 5-year yield in this first half of the table, and the 5 to 10 year forward rate in the second half of the table. To the statement surprise, and now we're moving to the press conference surprise or the monetary event surprise, and the general message is that these have significantly larger effects. And here where the 5-year break-even rate is particularly striking, you kind of, you basically almost double the impact, the coefficient here, and the R-square goes from 2% to 8%. So press conferences have a very substantial impact on break-even inflation rates. Monetary event window combines the two. So we think that's an important dimension that we should not be ignoring. There's also additional findings on excess sensitivity in long-term forward rates, but let me not dwell on those in the interest of time. Okay, so that's the kind of the treasury market response. So there is some additional excess sensitivity, but the headline finding really is a strong response of break-even inflation, and generally that if we want to understand financial market response, we need to look not only at the FOMC announcement, but also the press conference.
I think my question is maybe a good connection for you as well, because so you mentioned, and also your graph showed that the surprise measures to press conferences, especially in the later years, were like even negative sign, they were opposite sign to the surprise to the statement. So there was a positive measure of surprise. So would it be also reasonable to look at them in connection and to see, let's say, the measure of disagreement or disappointment between how to say consistency between the statement and the conference?
Yeah. I mean, I guess I think of it in terms of fully like noise versus signal. I mean, like capturing the signal more fully.
Yeah.
Like if I look at the daily reaction of the stock market, I want to understand the effects of, treasury market, stock market, of monetary policy. I can't just I need to measure the full signal. And if if the announcement goes in one direction, the press conference goes in another direction, that's particularly important. If they both go in the same direction, it's maybe not so important to measure them both. So in a way, I guess I could rephrase what you're saying. Like if there is disagreement between these two dimensions, it's particularly important to incorporate them both. Yeah. Okay, so here's a little bit more of these term structure figures, like the response of the break-even term structure. Now if you look at the press conference, like it like flattens out a little bit more quickly. Like you don't have this puzzling, like very, very long-lasting response. So I guess, 3 to 5 years. It's still pretty long. It's longer than VARs, so it's kind of a puzzle from that perspective. Same kind of message from the announcements and the press conferences. If you look at them separately, and if you combine them, you kind of get this overall picture down here. Okay, but that's just more color on kind of those same results. So let me move to the risk assets in the last 15 minutes. So the existing evidence says pretty clearly risk assets respond negatively to monetary policy, which makes a lot of sense, right? The discount rate channel is one, and then the cash flow channel is the other. That's the new channel here, right? Future dividends, earnings, cash flows go down in response to tighter policy. And so these are the two channels that are kind of obvious. And then there's the risk premium or risk-taking channel also. Like tighter policy is generally found to be associated with higher risk premia, and so your discount rate increases even more than the risk-free discount rate. So all of these channels lower, stock prices in response to tighter policy, and same for other risk assets. And I have a paper in the Journal of Economic Perspectives where we kind of revisit and extend the evidence on risk assets and risk appetite. And then plus Mike and I are also working on some new research in that area. There's some puzzling findings in this literature that I mentioned earlier. Frequent observations with wrong signed response, both in the stock market, that was Yarotinsky-Karate, AJ Macro paper, and also in the dollar also sometimes goes the wrong way. Gurkainak and co-authors. And then I mentioned these results for dividend strips, and then, so the story is, Fed information effects is basically saying, okay, what's this saying? Is this saying tighter monetary policy is a signal to the public that it's actually not bad news because risk-free rates are higher, but it's actually good news because the Fed must know something we don't know. This is like making people more optimistic, makes them revise up their dividend growth expectations. And if this is strong enough to outweigh the negative effects from this channel, maybe this channel, you might see the stock market respond positively to monetary policy announcements, right? Right, and then also people haven't really looked at the press conference in the minutes, so that's also something that's new here. Okay, so the like broad set of risk assets, how do they respond to the announcement surprise? So just a tight 30-minute window. Just kind of confirming earlier results. The stock market goes down, the VIX goes up. The VIX is basically the negative of the S&P 500 for all the practical purposes. The dollar, of course, appreciates. And well, I say of course. It's not everyone has estimated it this way, but this is what you would expect, right? Higher rates in the U.S. make the dollar appreciate because of capital flows. Monetary policy uncertainty. This is an option-based measure of that broadly falls in this risk and uncertainty category. This is from a paper I have with Amit Lakdawala, Philippe Müller in the Economic Journal. Tighter monetary policy makes people more uncertain about future monetary policy. And then this risk appetite index from my JEP paper with Bernanke and Milstein. Right, risk appetite falls very significantly in response to monetary policy. Okay, and then credit spreads. Okay, so the response around press conference is a lot stronger. For almost all of these assets, the R squared is significantly higher, and the T statistics and coefficients are just much bigger in magnitude. So if you want to estimate the response of risk assets to monetary policy, again, also here it's important to include the press conferences. Yeah, I mean, there's this caveat that the sample period is different for the press conferences, starts in 2011, but we've looked at like a comparable sample period, and so it's not due to the different sample period. It's actually due to the fact that this communication event contains different information. And then the monetary event surprise combines both. But I want to skip the minutes question. Yes?
Why you're not able, so it's not affecting the triple B spread, so the corporate bond spread?
So why is it not affecting? I mean, so it is, this is the statement. I went back to the first table. So here you do find an effect. The press conferences, there we don't find an effect on the corporate bond spread. Somewhat puzzlingly, also the risk appetite becomes insignificant. So it's not across the board. I was a little too quick with that, sweeping something under the rug, the last two columns in particular. But you know, I'm kind of comforted by the fact that if you combine the announcement and the press conference, then you do kind of get that picture. So it's I mean, these R squareds are pretty low, so in these kinds of regression it can really matter. You know, the change in the sample period, and if you have some kind of noisy estimate of the monetary policy signal. But yeah, I think the broad strokes is that also for most risk assets, it's important to include the press conference. Okay. Yeah, something that we're still working on is like, you know, mortgage spreads and mortgage rates. You know, that's a really important part of monetary transmission in the U.S. And when you look at the MBS market, you can actually get daily data there, and so that's something that we're still adding. Yeah, the thing with the corporate bond market really is, you know, I found this in my earlier work also. It takes a while. Like, this is so illiquid, this market, that like on the day off, it actually goes the wrong direction because treasuries are so much more liquid and corporate bonds don't move until several days after, and so. It's kind of, they're pretty sluggish, so might be worth kind of revisiting this, like giving it a few more days, or like looking at the time pattern of the response. All right, so these are scatter plots of the S&P 500 on the day of the announcement on the y-axis, and the monetary policy surprise on the x-axis. And the gray shaded area is the standard deviation plus minus 0 of the monetary policy surprise. Yes?
Could it be an idea, instead of looking at the whole market, having a bit of a subset that is differently, that behaves differently to rising interest, such as value and growth stocks, as an index that doesn't exist, so it could be easily done? So perhaps that could explain the different reaction of the overall market to rises.
Yeah, no, that's an excellent suggestion. So, in fact, my former doctoral student, Eric Offner, who's now at the ECB, he's looked at the response of value and growth stocks, like this heterogeneity. I mean, there's a whole literature on the heterogeneous stock market response. A lot of people look at leverage and liquidity, but it is a kind of first order whether these stocks are value or growth. In particular, if you think that the growth stocks have longer duration, you'd kind of expect them to respond more strongly to changes in discount rates. And so that is what he finds, that growth stocks respond more strongly. What we have not done and what might be worth investigating is whether the what the press conferences do to growth and value stocks, and look at it from that dimension. But yeah, I'm really interested. I think it's very important to go beyond just an SP 500 and all stocks, like bunching them together, and instead actually thinking about what portfolios, what kinds of stocks respond stronger and less strong, because that really is important for monetary transmission. Okay, so all right, so Jarotinsky, Karate were saying, look, there's a lot of dots in the wrong quadrants. Yeah, that was basically, I mean, they do much more very interesting things in their paper, and I'm oversimplifying, I'm not doing justice to their paper, but one of their points was that there's a lot of dots in the wrong quadrant. And so isn't that puzzling, right? And it is a little bit oftentimes there's like an easing surprise, and the bottom falls out of the stock market, right? So we would emphasize, and Eric Swanson and I have done this before, that if you shouldn't really pay attention to all of these really, really small surprises. Like, those are not that relevant. But admittedly, even if you look at surprises that are bigger than a standard deviation, there's a fair amount of puzzling observations here, right? So here, one small thing that we add is say, look, if you look at press conferences, and if you kind of go again, like focus on the surprises that are material and bigger than a standard deviation, you have almost no wrong sign stock market response. In fact, only 2. And these will need to take a closer look at, but it's very, very rare. Okay, usually stock market response is not puzzling. Right? Neither the average response with this negative, as we'd expect from the theory, nor for most individual announcements, there's really no puzzle there. Okay, but that's just a small addition. Same for the dollar, by the way. But let me talk about dividend derivatives for a few minutes, okay? So these dividend strips, you can kind of construct these prices of a dividend claim by using, well, the underlying S&P 500, and then using put call parity and S&P 500 options, which don't give you the right to dividends, right? And so that way you can kind of, using no arbitrage and put call parity, you can construct prices of a dividend claim. They have very short maturities because options have short maturities, but they do have a pretty long sample. So you've got like 20, 25 years there. Dividend swaps have an almost as long a sample, but they have several years out in horizons. So that's great. 1 year, 2 year, 3 year. They're also not imputed from any options. They are, we've got this data from Goldman Sachs, like they trade this stuff. Negative is it's over the counter and it's pretty intransparent. You don't know volumes, you don't know bid-ask spreads. So it's, pros and cons, but they're pretty useful. Dividend futures are kind of the best, right? Very transparent, exchange traded, you know everything about them, but they're only available since 2015. This is a pretty young market. In the early years, they weren't particularly liquid. All right, so, and let me say again, like this evidence, like based on these, it has this puzzling sign that, prices of dividend claims are positively correlated with monetary policy surprises. Okay, so we do this for dividend futures and dividend swaps, and we find the opposite. We find, for example, here on press conferences, maybe let me focus down here on the monetary event window, This is for the future, so pretty short sample starting in 2015. But even there, we find significantly negative response. It's not exactly so small, right? This is like -6%. So this is like a 2-day log return around the FOMC announcement. So the price of dividends 3 years out goes down by 6% in response to our monetary policy surprise. And that's also the peak. 3-4 years is kind of the peak impact. It varies a little bit across events, but there's also this significant expected lag. This is from swaps, longer sample, but generally very similar findings. 3 years is the peak impact around here for all of these events. Significant negative response of the dividend swaps and dividend futures. Okay.
Why would you expect a negative response in the short term? Like my understanding, the short term is the next year dividend.
Right.
So if rates increase and investments are no longer profitable, shouldn't short-term dividends increase, returning money to shareholders?
That's a good idea. Folks have not come up with that idea. So So folks have usually come up with a Fed information effect story that people somehow expect higher dividends because the Fed reveals good news about the economy. But this is a channel that people have not brought up. I mean, I guess our thinking is that was in the short, like you would expect this to take some time. You'd expect a negative effect mainly after dividends, for the horizons that dividends are expected to go down. And that it would take some years, but yeah. So maybe it's consistent with that because at the very short end we find weaker effects or even positive effects. So yeah, exactly. So this is exactly where the literature is at. I mean, trying to reconcile these puzzling positive impacts of the dividend strips, maybe with our new results from dividend futures and dividend swaps. That's kind of the issues in the Fed information effect literature. All right, so let me wrap up. Okay, so we've got this new, what we call the U.S. Monetary Policy Event Study database, USMPD, totally stolen this kind of acronym from the ECB that called it basically this. And the Riksbank and the Bank of England also. So everyone's calling it the same thing, but now we have it for the US too. Okay, it'll be hosted by the SF Fed, by where I work in our new Center for Monetary Research, and hopefully that'll be useful to researchers. And we've got some interesting, so in this paper, obviously we're introducing this database, but we also have some empirical results that we think are material contribution to the monetary economics literature, and I've talked at length about them already in the treasury market, risk assets, and then both across the treasury market and in risky asset markets, significant expected lags according to these term structure estimates. And a recommendation for people to move away from these tight 30-minute windows to actually include all of the relevant signal about monetary policy coming from the FOMC. Okay. I'm sorry I didn't leave any time for additional questions, but that's all I have.
No, but thank you very much. And I think it's fun. We had some questions in the interim, so just to make sure we don't have any surprises here in terms of the timing of people's schedules. It's been a great pleasure to have you here at our latest working lunch, and our great pleasure again to have our IMFS research fellow, Michael Bauer from the San Francisco Fed here giving us our presentation. So until next time, have a very, very nice afternoon.